Kyle, so good to see you. A really timely topic, how to invest when interest rates are cut. Interest rates have been high since March of 2022, but they are finally coming down. That means it's time to rethink how we're investing. But first, why is the Fed now lowering rates?
Hey, Erin, great to be with you. And that's a great question. Well, it's going to change. The landscape's going to change quite a bit. And I think it's going to get some people out of their comfort zone when it comes to the bank accounts in particular. But to me, look at why are we lowering the rates? And I go back to why do we raise them in the first place? Well, it's because, like the visual on the screen says right there, inflation was running too hot. The economy was overheating, and we were seeing inflation rates that we hadn't seen since the 70s and 80s. And so,
Yeah.
what the Fed did is they used the primary tool in their tool chest, which is manipulating interest rates, to try to cool the economy off. So, kind of put some guardrails around it. Now we're starting to get some information, especially on the unemployment side, which is part of the Fed's dual mandate, meaning they have two jobs: maintain price stability and maintain employment. And so now we're seeing unemployment begin to tick up to levels that they're uncomfortable with, among other things, inflation coming down some, to where now we're going to start lowering rates.
Yeah, it's definitely a lot of moving parts. And of course, by raising rates, a lot of people were concerned that that would push the economy into a recession. When will we know if we've avoided a recession?
Well, I don't think there's a black and white way to know exactly when we're going to see that recession. I don't think there's going to be a parade in New York City that tells us that we're out of it or anything. But I think we'll look back on these times and make those discretions there. But to me, I don't think it's going to be clear cut or black and white at all. I look back at the 70s and 80s. We had a similar problem, albeit much, much worse. And that took a series of rate hike and cut cycles. And we're entirely prepared to manage portfolios through something similar.
Mhm. All right. So now let's talk about investing when rates are coming down. What's the biggest difference?
Well, the biggest difference is that, like I alluded to earlier, I think that a lot of people that are comfortable with their 5%, five and a quarter money markets and bank CDs,
Yeah.
that's going to change pretty fast. And so that'll be the first thing to go. And people are going to have to get off the sidelines again, I think, and participate in markets over the long term if they jumped out.
hmm And so now let's talk through some specific investments that people should maybe consider in a low
Sure.
interest rate environment. First would be small cap stocks, high yield investments, bond ETFs, REITs or real estate investment trusts, and housing stock. What is interesting here in this grab bag?
So I think that all of these investments share one similar characteristic is that they are uniquely sensitive to interest rates.
hmm
And for me in particular, more aggressive investors, we've been looking at small cap stocks and strategies to manage those types of investments. And so, as rates come down, the small cap stocks, those are smaller corporations that are publicly traded. If it's easier to get your hands on capital, right? It's easier to borrow money. A lot of these guys borrow money. It's easier to grow your business. So I'm excited about those. High yield investments, I think, are going to be less appealing to me personally because of the risk that they carry. Remember, we're cutting rates because there's a little bit of warning signs about the economy. So high yield investments are usually higher risk.
hmm
Now, bond ETFs, as rates go down, bond par values go up. So that's something I'm excited about. And then in this country, we do have a housing shortage. So we
Yes.
need more homes, right? We don't have enough inventory. And so I'm very excited about REITs in that regard. They are interest rate sensitive. I'm a little bit skeptical on the corporate side of the REITs because I don't think we're entirely out of the woods there, especially if businesses may be struggling in some areas. So I'm careful about that. And our last one, housing stocks, someone's got to build those houses, right? So I think that the home builders are going to continue to benefit from a lower rate environment and the fact that people need more homes.
Interesting. Yeah, a lot to consider, a lot of moving parts. Carl, if somebody has any questions about the specifics that we've covered, or they'd like you to take a closer look at their portfolio to make sure that they are properly diversified in this current environment, what's the best way to reach you?
Sure. The best way to reach us is through our website, and that's firstcoastfinancialgroup.com.
Great. Kyle, thanks for your time today.
Thank you, Erin.